What is a cap rate? Let's break that down today. Hey, I'm Tim Diesel. I'm a commercial real estate consultant. This channel is designed to give you tips and strategies in your investing business. If you're a broker, this will definitely help your clients. All right, let's talk about cap rates. We all have heard this is the thing you're looking for whenever you're investing in anything. Well, I'm here to tell you, not really. There's a couple of things we want to look at. So let's talk about what is a cap rate first, right? So if I'm an investor and I've got $1 million cash and I want a 10% return on my money, I need to buy a property that the net income is $100,000, right? That's how I get my 10%. So that would mean you're taking the net operating income of the property and you're dividing it by what it's worth, or what the value is in that market. And this is the number one thing that you're going to notice. The same income stream in Los Angeles, California is different than in Florida, where I am right now. And it's not that the income is different. It's that investors are willing to accept a reduced cap rate, where in my market, you might see 6%. Well, in downtown Boston or wherever the cap rates are extremely low, that same exact income stream is going to be a 4% cap, which would mean the return on the property is considerably less because of the market, right? Now, if you're buying in Kansas City, maybe Oklahoma, I don't know their markets extremely well, but I imagine they have a much higher cap rate. So the first thing to know is cap rate is just the return on the property. Now, this is very important. This does not include the mortgage. This formula assumes you have the property paid off. There is no debt on this property. That means if we're going back to the same example and you're putting $1 million cash onto this property, your $100,000 is no debt. There is no financing at all. The minute you get financing involved, you're looking at a cash-on-cash return, which is different. Let's stick to cap rate for a minute. If the same buildings are right next to each other, and this is an office building, let's say in this example, same exact builder, same exact floor plan, same exact everything. One building has $100,000 net income, and that investor wants a 10% return. He's going to sell it for $1 million. That building right next door is not the same value because it does not produce the same amount of income to the investor. We are in a cash flow environment, right? Nobody buys these things just to collect them. We're buying the income stream, the security. It's got to be stable. That's what we're looking for. So if you're going to buy a 40-unit apartment building, you're going to be getting a much different rate of return than if you're buying a single tenant Walgreens. It's just the way it is. So now that we kind of broke that down a little bit, here's what I don't like about cap rates. They not only do they not take into effect the mortgage that you have on the property. So if you have a first with Bank of America or something, and then you have a private investor for a second, they don't really calculate that, which isn't great. They also don't calculate capital expenditures. So if you're going into the property and your first year you've got to do the roof, the windows, whatever else, that income is actually going to really skew your cap rate formula, because it's going to look like you have a 3 cap and you really have a 6. So that's another thing that's really not very great about them. I always say cap rates don't really matter depending on what you're trying to go after. If you're going after a value add investment, you should not even waste your time looking at cap rates. And I think cap rates are more for that Class A investor that is really looking for a safe, secure income stream. He's got to heavily focus on cap rate. Because if you have a Walmart in there for 20 years, you're kind of stuck with it, right? You're only going to get returns based on the increases every year or 3 years or whatever, however that lease is. All right, now another thing is a cap rate of 4% So a property has a 4% cap rate. It's going to be much easier to increase the dollar value than a 10% cap, because that's the advantage of cap rate. So it's gonna be a little light maybe on the cash flow when you're getting in, but the minute you start increasing those factors of whatever it is you have, it's going to start increasing much quicker because it's the same return. So if you're going in there and you turn the value from $1 million to $2 million, well, you're getting now a 5% return on that $2 million. You're not getting a 10% return. Whereas if you bought it and there was a 10% return on the property, even if you increase the rents, even if you turn some things around, you're still selling somewhere around that 10%. You cannot just drop the cap rate to 7. People are not going to just buy that. You're going to be somewhere up there. So if the market is going for 9, you can probably be at 8.5 depending on the property. Now, if you bought and you had a 4 or 5 cap in that market, well, your value is going to be tremendous because you're raising the actual dollar amount of the property up. You see what I mean? So that's where cap rate can help you. A lower cap rate means you're going to make more money. It just means you're going to get less return on the property. So that's not necessarily a bad thing. It could be a good thing depending on how many investors are involved, what you're buying, how long the investment is. There's a couple other things to notice there. Finally, I want to tell you something about cap rate. Do not compare investments because that's not fair. I see that a lot. Don't ever do that. Whenever someone is telling you something, they'll say, oh, you're going to get a 8% return, which is better than the stock market. Well, who cares? Stock market investing is stock market investing. Real estate is real estate. You're talking about two different things. If the CEO of the company gets accused of a crime, the stock plummets. That's absolutely no comparison whatsoever. If you're a real estate holder, that's totally different. If it's a REIT, that's a different thing. So whatever the cap rate is, that's on the property. What you want as an investor is what is the return on your investment. So if you're putting up $100,000 and the property is a 10 cap, well, if you have financing on it, you may not get 10% return on your money. You may be getting 15 or 20% in some cases, right? It really depends on how much money you're putting in. So the formulas are different. Don't make this extremely complicated. At the end of the day, you're going to hear all kinds of formulas. There's going to be IRR, there's going to be all this other stuff they're talking about. Keep it simple. Either it makes money or it doesn't. Either you can turn the value around on this thing or you can't. This is not that complicated. Really keep it simple. And the cap rate is important, but it can change. I want to give you one last example on a cap rate. I've bought a property and I think the cap rate on it was 3.5%. But let me tell you about the terms. I was able to buy it with literally 1.5%, 2% down. And I had owner financing on the deal. And I still made money on the property. And if I was to call some investors in my book of business and I was going to offer them a property at 2%, they would probably say, I'm really not interested. It's not something I'd want. So cap rate is important, but it's just a modifier. Those terms can always change. If you make it very easy for someone to acquire your property, owner financing, whatever the case is, that cap rate's going to change a lot. It really depends. So cap rates can always be altered. That's why I say don't look at cap rates. It's not the only thing. You have to be able to get into the deal and get out of the deal. All right, like this video, subscribe to this channel, especially if you found this information useful. Ask me questions, comment below. I'd love to answer them. Thank you so much for watching.